Hi everyone, this is Alan Rosinski of Metro Manhattan Office Space. Good afternoon. The commercial real estate business is capital intensive. Most office buildings, commercial properties that you see are heavily mortgaged. Typically what happens are landlords get mortgages on their building, they use the capital to acquire other properties. So if there's a situation where there's a credit crunch and their tenants are not paying their rent, it can cause very serious problems. There can be defaults on loans. Landlords can have difficulty repaying back their loans because they assumed a certain occupancy rate in their buildings and a certain rent collection rate, which is no longer the fact under current circumstances. Now, different sectors within the commercial real estate industry are affected differently. Retail at the moment now is in terrible distress, with many stores not paying their rents. Office landlords are somewhat of a different situation. The landlords which have larger credit tenants in their building are experiencing less difficulty. Landlords with smaller tenants have probably a significantly higher default rate. Now, one sector which has been particularly hard hit are hotels. And you see this being in Manhattan. I mean, you walk around in a neighborhood, many of the hotels are shuttered. I live on the Upper East Side, and for instance, the luxury hotel, the Plaza Athénée on 64th Street, very elegant location, very high-end, expensive. I would be surprised if any rooms there were available for less than $500 a night. That's just shuttered shut. Looks kind of depressing, very quiet. You kind of walk by the street, you want to avoid it. And of course, you have another example, the Loewy's Regency on 63rd Street on the west side of Park Avenue. It's totally renovated about 3 years ago. The hotel was shut down. Certainly, the owners took a major mortgage and major construction loan to do that. The hotel was rather successful. So you'd see it jam-packed during, say, the meeting in September when the UN would be meeting in New York. They had a restaurant bar there, which was known as a venue for power lunches. All these well-known people would meet there. I mean, I used to like it before. It used to be an old-style hotel bar with a library. It had a certain amount of charm until they renovated. However, it was still very popular. Another example, again kind of sad, is a hotel called the Roosevelt Hotel on 45th Street to the east side of Madison Avenue. This hotel was built, I think, about 100 years ago, 1922. Beautiful, vast lobby, conveniently located near Grand Central Station. The hotel had survived the Great Depression, the 1970s, the lull in tourism after September 11th, and it made it through everything until Corona hit, and they announced last week that the hotel is closing after almost 100 years. Now, I'm bringing up hotels as an extreme example in the commercial real estate industry. They have been particularly hard hit, see it in Manhattan, but I'm sure that's the case also nationally. Now, the Wall Street Journal had an article about a week ago about the commercial debt market for real estate loans in New York City has really taken a hit. And when I read this article, I immediately thought about the debt crisis, the housing crisis of 2008 and 2009, and was thinking to myself, my God, I hope we don't have a replay of this in another 6 months if many commercial landlords in New York City and the rest of the country can't pay the mortgages on their building and buildings. So to give you a little bit of background, there are two types of mortgage markets, a primary market and a secondary market. The primary market is when you, as a landlord, go to your bank and you take out a mortgage. Typically, what will happen is the mortgage will have a term, say, of 10 years, but the amortization schedule will be based on 20 or 30 years. So after 10 years, you've got part of the loan paid back, but you owe the balance. And then typically what landlords do is they take out another mortgage then again. So they're constantly using debt, very capital intensive industry. Now, what happens with the secondary mortgage market, the banks and financial institutions which have issued the debt, the mortgages, they securitize this debt. They sell the debt. They get it off their books, just like what happened with residential mortgages about 15 years ago, 13, 14, 15 years ago. And the banks found themselves, and there were all sorts of financial instruments which had this debt, which became non-performing, and the value of those financial instruments dropped. So just like then, right now, the value of debt which is traded for New York City commercial mortgages has dropped in value because people, investors who purchase this debt, perceive risk. So in order to buy it, they're willing to pay less and they're expecting a higher yield. So why is this important? Why is it going to make a difference if financial securities that base their value on New York City commercial real estate mortgages drop in value? Well, I'll tell you, if you, your parents, grandparents have a pension fund and that pension fund holds these financial instruments, well, the value of their pension is going to be reduced, which is not going to be pleasant. Let's say you own a small hotel in New York City or even a small office building in general. It's going to be more costly. Interest rates on commercial loans are going to increase, and the availability of loans for the commercial real estate industry is going to be reduced. Now, New York was hit at a very early stage by the pandemic. I mean, it could be a bellwether for what's going to happen to the commercial real estate industry in the rest of the country. So let's say in another 6 months' time, there are massive defaults by landlords, by the, even certain sectors. The hotel industry pretty much goes into default, or retail landlords, owners of shopping centers can't pay their mortgages. I mean, it makes me think of the financial crisis in 08-09. You could have some banks which are hit in a very major way. Maybe you'd even need a government bailout. So that would affect the taxpayer. Now, of course, let's say you are a real estate developer in New York City and you have a project which even in difficult economic times is viable. It will probably be more difficult to get capital. There'll be less capital available and you'll be paying a higher interest rate. So it's generally not good for the economy, national economy, local economy. And let's say somebody is a tradesman, a carpenter, a plumber, and because of reduced access to capital, higher capital costs, there's fewer construction projects. Well, you may be working a little bit less. Hopefully it's just a little bit less. So, I think this is newsworthy. We have to keep our eyes on this problem and hopefully conditions will improve. Everything tends to be cyclical and hopefully we are on our road to a recovery in the near future. If you found this content useful or interesting, I'd be happy if you subscribe to my YouTube channel. I'm always on Twitter. My Twitter handle is @Metro Manhattan. Until the next time.